Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone for all of your support on the channel. All the viewers, all the subscribers, immensely appreciate the support. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, I want to talk about the portfolio and the overall stock market performance over the past 1 week. You can see here the portfolio is down quite a large margin today in the red, 1.96% down, 27.8070. And over the last 1 week of trading, you can see it's down 5.94%, $8,817.68. If we take a look at the overall portfolio, and again, on the left there, I have all my stocks arranged per market segment. You can see there is no market segment that has been spared here. My high yield ETFs up on top there, all in the red. Pharmaceuticals in the red as well. And there are quite a few stocks in the 2, 3, even 5% range in the red today. There are a few stocks in the green. Defense, BA Boeing, and Lockheed Martin, LMT, Aerospace and Defense in the green today, 0.74 and 3.1%. But overall, very, very poor day in the market. You can see 3M up on top, down 5.81%. Ford, one of my larger holdings, the largest holding actually in the portfolio, down 1.4%. GM, 3.16%. There are a few companies in the green, but for the most part, every market segment here in the red, and in the red by quite a large margin. And there have been a few viewers on the channel wondering, in this particular scenario, what should an investor do? Should you jump out of a stock, essentially employing stop losses for your positions, getting out of a stock, presuming that the market will continue to pull back with the looming trade war with China, with other developments, geopolitical developments? Should you simply hold your stocks and sort of ride out this momentary volatility in the prices of your stocks? Or should you actually start adding capital to stocks with the idea that stocks are now on discount? You can pick up stocks that you are holding for longer term, or even stocks that you are going to be setting up a day or swing trade with the anticipation that next week the stock market will start rebounding. I think I would be putting money into the market. Again, I would have to do it on a very selective basis and put it into stocks that you think would be very good long-term holds, because there's no guarantee that the stock market is going to rebound next week. It could continue to trend down. And for positions that you are going to be holding longer term, you can definitely start averaging down in a dollar cost averaging, value cost averaging type of strategy. But I do want to focus on a couple different stocks here just to show you some perspective on what the last year of trading has done for a lot of stocks on the market. So VYM here, you can see it is down 1.96% today. Over the past 1 week of trading, it is down 5.39%. This looks like a very attractive evaluation. But I wouldn't simply focus on the price of the stock. You can see the price of the stock is $80.94. But I would focus more on the price to earnings ratio, PE ratio, 23.75. There are a number of other metrics you can take a look at as well. But I find PE ratio is a very simple and easy metric to understand. It's simply showing you how many dollars an investor is willing to spend for every $1 of earnings. So for every dollar of earnings in this company, an investor is willing to buy the company for $23.75 essentially. So I would kind of focus on that, because if we take a look at the market over the past 1 year of trading, you can see this stock is actually up 6.94%, which would be a very good rate of return historically in the stock market. Yes, you can get a little bit better with that particular rate of return, but 6.94% each and every year I think would be a very good rate of return over the longer term. You can also take a stock like AbbVie here, currently trading at $97.20, pulling back here 6.65%. Over the past 1 week of trading, you can see it's down 14.57%. So again, just focusing on the price of the stock, you may think this is a very good valuation to jump into. But if we take a look at the price to earnings ratio, you can see it's still rather high here, 29.63. Again, this is essentially meaning that an investor is willing to spend on this company $29.63 for every $1 of earnings. But if we take a look at the 1 year graph, again, this stock is up 53.27%. That is an outstanding return over a 1 year period. So this stock still may be very overvalued. If we take a look at another similar stock here, Pfizer, Somewhat the same type of business operations with regards to its market cap. A little bit bigger here for this company, $212.85 billion, compared to, I believe, $150 billion or so for ABBV, $156.19 billion. If we take a look at the PE ratio, you can see this is a much more attractive valuation. So for this company, an investor is willing to pay $9.83 for every $1 of earnings, much more attractive than ABBV. And if we take a look at the 1-year rate of performance as well, you can see this company is only up 4.44%, 1 point up 13 to 16, 17% or so. So I think based on just that one metric alone, and again, there are a number of different metrics you can take a look at, this would be the much more discounted company. This would be the better valuation here versus an ABBV. There still may be a lot of room for this company to fall, again, because the outrageous rate of return over the past 1 year, 53.27%. That is not a typical rate of return. And the company really hasn't had any groundbreaking new pharmaceuticals come out. Pfizer here, a much more reasonable rate of return. With the big pullback here, I think this would definitely be the more valuable company for a longer-term buy and hold, or even setting up for a shorter-term swing trade. Again, this is my opinion only. I'm not a market professional. But taking a look at the PE ratio versus the price of the stock, I think is very important. Don't simply focus on the price of the stock to see, hey, it is down a certain percentage here. Again, versus an AbbVie, this looks like the better buy because it's down 14.5% versus Pfizer here down 6.2%. But if you take a look at the PE ratio and the longer-term rate of return, you can see Pfizer is probably the better buy, the better valuation currently for Pfizer. Again, this will depend on the individual company. Another thing to take a look at as well is if we take a look at Abbott Laboratories here, another company that I think would kind of fall into an AbbVie. It is up 35.94%. AbbVie with regards to rate of return. The PE ratio here is very, very high, 221.126 for the price to earnings ratio. But you can't compare an AbbVie to an Abbott Laboratories just because they're different business operations. You can compare an Abbott Laboratories to a Cardinal Health, for example. And you can see here, this is probably the better valuation. But again, it all depends on the underlying business operations of a company. If there are two similar companies with a similar type of business model, you can compare between PE ratios. But if they're completely different, you can't really do that. Cardinal Health is somewhat different than Abbott Laboratories, but it's much more similar than a pharmaceutical stock like AbbVie Incorporated or a Pfizer. So just take that into consideration. Don't always focus on the price of the stock alone. Take a look at the longer-term rate of return as well as the price to earnings ratio. Get a little bit better perspective on whether to jump into a stock or not. So that is my perspective. I definitely am going to be putting more money into those stocks I think would be very good long-term buy and hold stocks. But as you guys know from my day and swing trading videos, I also put money into these types of stocks with the intention of doing swing trades. So if I can get into a stock and out with a reasonable rate of return, I'll definitely will do that. But I buy stocks I can hold for the longer term. So if I can't get out of a trade, I'm more than happy holding it longer term and picking up a great dividend. Pfizer, for example, 3.589% dividend yield. So I think I probably will be putting money into pharmaceutical companies as well as some other select companies and that I think would be very good rates of return over the longer term. But again, this has to be an individual decision. Kind of interesting here, GE, I think was down below $13 at one point today, momentarily. You can't see that in the graph here. So I originally was going to jump in if it did get below 13. Not quite sure about GE right now. But there are a lot of companies that I think would be very good long-term buy and holds or even setting up for swing trades. But again, take a look at the company with regards to longer-term perspective, rate of return, as well as the price-to-earnings ratio. I think you have a much better perspective than simply focusing on the price of the stock alone. So let me know if you guys have any other tips or tricks for identifying value stocks in your portfolios. That's what I kind of take a look at. I don't, again, simply focus on the price of the stock or how it's been doing over the shorter term, 1 week. I take a look at the longer term perspective to see if there is reasonable valuation to put more money into the stock or not. So let me know either way what you guys are doing with your portfolios, if there are better or different metrics you are focusing on to identify value stocks. And not to make the video too long, I guess I'll end it here. Again, if you guys enjoy my videos, feel free to like, share, and subscribe. If you guys have any comments about this video, other videos, please let me know in the comment threads down below, and I'll do my best to get back to you guys as quickly as I can. So kind of with that, I'll end the video, and we'll see you guys next time.